A $90 million deal just closed in the silver market, and almost no one is talking about it. One of the world's most recognized silver producers just sold off one of its own mines. Not a struggling company, not a company in trouble, a company that just raised its production guidance. So why would a silver miner willingly give up ground it already owns? Why now, in the middle of one of the most volatile years precious metals has seen in over a decade? Some analysts are calling it smart corporate strategy. Others are calling it something else entirely. A quiet signal, a warning, that the physical silver you rely on may not be as easy to find in the coming years as it is today. By the end of this video, you will understand exactly what this deal really means, and why it could directly affect anyone holding, or planning to hold, physical silver. Stay with us, because this story is only getting started. Welcome back to Precious Metals. Intelligence, the channel dedicated to helping serious, wealth-conscious viewers understand what is really happening beneath the surface of the precious metals market. In the world of precious metals, most people watch the price of silver every single day. They check the charts, they check the spot price, they wait for the number to move up or down. But there is another side of the silver market that most people never watch at all, and that side often tells a much bigger story than the price on the screen ever could. That side is the world of the mining companies themselves. Mining companies are not just businesses that dig metal out of the ground. They are early warning systems. They know things long before the general public does. When a mining company makes a big move, it is often reacting to something happening deep inside the industry, something the average investor has not noticed yet. This is exactly why a recent announcement from one of the world's most well-known silver producers deserves close attention. The company is called First Majestic Silver. For many people who follow the silver market, this name is instantly familiar. It trades under the ticker symbol AG, which happens to be the scientific symbol for silver itself. Over the years, First Majestic has built a reputation as one of the leading primary silver producers on the planet. It is not a small, unknown company. It is one of the major players. So when a company like this makes a significant move, people in the industry take notice. Recently, First Majestic signed a definitive agreement to sell one of its own mines. The mine is called San Martin, and it is located in Mexico. The company has owned this mine completely, 100%, for years. Now it has agreed to sell it to a private Mexican buyer for a total of $90 million. At first glance, this might not seem unusual. Companies buy and sell assets all the time. But this deal did not happen alone. It happened just weeks after First Majestic completed the sale of another one of its mines, called Toro, for $60 million. Two major mine sales, in a very short period of time, from the same company. This is where the story becomes far more interesting. Because here's the question that serious investors and long-term silver holders should be asking right now. Why would a strong, well-known silver producer sell off two of its own mines during one of the most active and volatile years the precious metals market has seen in a long time? If silver truly is becoming more valuable, and if demand for physical silver continues to rise, then selling off mining assets seems like an unusual decision. It raises a natural concern. Is this a sign of financial trouble? Is the company struggling behind the scenes? Or is something else going on? Something far more calculated? This is not a simple story with an obvious answer, and that is exactly why it matters. Some people, seeing only the headline, might assume the worst. They might think a company selling off mines is a company in decline. But the reality of corporate strategy in the mining industry is often far more complex than a single headline can explain. Companies do not always sell assets because they are weak. Sometimes they sell assets because they are repositioning themselves for something bigger. The real story is not simply that a deal happened. The real story is what this deal reveals about the future of physical silver supply, and what it might mean for everyday people who hold silver as a store of value. To understand that, it becomes necessary to look much closer at the deal itself. Not just the headline number of $90 million, but the actual structure behind it, how the payments are arranged, how long the deal stretches into the future, and what that structure quietly reveals about the company's real intentions. Because when a major mining company builds a deal this carefully, it is rarely just about clearing an old asset off the books. It is usually about strategy. It is usually about positioning. And in this case, it may be about something that touches every single person who owns physical silver today. The next part of this story goes inside the mechanics of the deal itself, the numbers, the timeline, and the financial thinking behind one of the most talked about silver transactions of the year. Numbers rarely tell the whole truth by themselves. A single figure, like $90 million, can sound impressive on the surface, but real understanding only comes when someone looks past that number and studies how it was actually built. And once the structure of this particular deal is examined closely, a much clearer picture begins to form. First Majestic did not simply hand over the San Martin mine and receive a lump sum in return. That is not how this agreement was designed. Instead, the deal was carefully structured to unfold slowly over a period of several years, with payments arriving in stages rather than all at once. At the moment the deal closes, First Majestic receives a relatively small payment upfront, just $2.5 million. For a deal worth $90 million in total, that initial amount is a small fraction of the full value. Then, within 180 days, another payment of the same size arrives, $2.5 million again. After that, the real structure of the deal begins to show itself. Starting from the anniversary of the closing date, First Majestic is set to receive $10 million every single year for 5 years in a row. This is not a one-time transaction. This is a long-term financial arrangement stretched across half a decade. And finally, the deal reaches its conclusion with one large final payment, a lump sum of $35 million, arriving all the way out in the year 2032. When someone lays out this timeline from start to finish, a very different picture emerges than the simple idea of a company selling a mine. This is not a quick exit. This is not a company trying to unload an asset as fast as possible for immediate cash. If that were the goal, the company would have negotiated a larger upfront payment and walked away. Instead, First Majestic chose the opposite approach. It chose patience. It chose a structure that provides a steady, predictable stream of income for years into the future. This detail matters more than it might first appear. A dormant mine, one that is not currently producing any silver, does not generate any income on its own. In fact, it often costs money just to maintain, keeping a closed mine safe, stable, and ready for a possible future. Restart requires ongoing spending, even though no metal is coming out of the ground. By selling San Martin under this type of structured agreement, First Majestic effectively transformed an inactive, cost-generating asset into a reliable, long-term source of guaranteed cash flow. Instead of a mine that drains resources every year with nothing coming back in return, the company now holds a contract that pays it steadily for the better part of a decade. This is an important distinction for anyone trying to understand what is really happening here. A company in genuine financial distress typically wants cash immediately. It negotiates for the largest possible upfront payment, even if that means accepting a lower total value for the deal. But that is not what happened in this case. First, Majestic negotiated a deal that prioritizes long-term, dependable income over a fast cash grab. This single detail changes the entire tone of the story. It suggests a company that is thinking carefully about its financial future, not one that is scrambling to survive in the present moment. There is also something else worth noticing in how this deal was built. The final, largest payment of the entire agreement, $35 million, is not scheduled to arrive for several years. This tells us something meaningful about how First Majestic views its own position in the market. A company does not agree to wait years for its biggest payday unless it has confidence that it will still be operating, still be financially stable, and still be positioned to receive that payment when the time comes. In other words, the very structure of this deal is a quiet statement of confidence. It reflects a company that is planning for the future, not one that is simply trying to survive the present. But this naturally raises another important question. If First Majestic is confident about its future, and if this deal was clearly not built out of desperation, then why sell a mine at all? Why give up ownership of an asset, even a dormant one, if the company is financially secure? The answer lies not in weakness, but in strategy. And to understand that strategy fully, it becomes necessary to look at what First Majestic is actually doing with the mines it has chosen to keep, and where all of this newly freed up capital is now being directed. At first glance, the word selling tends to carry a negative meaning in the business world. And when people hear that a company sold off an asset, many assume something is wrong. They assume trouble. They assume weakness. But in the case of First Majestic, this assumption misses the real story entirely. To understand what is really happening, it helps to ask a simple question. What is the difference between a company that is shrinking and a company that is streamlining? A shrinking company sells assets because it has no other choice. It needs cash to survive. It cuts operations because it is struggling to keep the business afloat. A streamlining company is different. It sells assets on purpose from a position of strength in order to focus its resources more tightly on the areas where it can perform best. The evidence strongly suggests that First Majestic falls into the second category, not the first. Consider the basic facts. This is not a company that is producing less silver. It is not a company retreating from mining altogether. In fact, First Majestic recently raised its own production guidance for the year, increasing it by 10%. That is not a small adjustment. That is a significant, confident statement from a company about its own near-term performance. How can a company raise its production targets while also selling off 2 of its mines within the same short period of time? The answer lies in where the company is choosing to place its focus. First Majestic currently operates several underground mines across Mexico that remain highly active and highly productive. These are not aging, struggling operations. These are the company's strongest performing assets, delivering higher output and improved efficiency in extracting metal from the ground. In other words, the mines that First Majestic chose to keep are the mines doing the heaviest lifting for the entire company. By comparison, the mines the company chose to sell, including San Martin, were not active contributors. San Martin, in particular, had been sitting in a state that the mining industry refers to as care and maintenance since the year 2019. This means the mine was not producing any silver at all. It was closed, but still being carefully maintained, just in case it made sense to reopen it again someday. A mine in this condition does not generate revenue. It does not add to production numbers. Yet it still requires spending, simply to keep it safe, stable, and structurally sound while it sits idle. In business terms, this is often referred to as dead weight. It sits on the company's balance sheet, quietly costing money without contributing anything productive in return. By removing mines like this from its portfolio, First Majestic accomplished two important goals at the same time. First, it eliminated the ongoing cost of maintaining non-producing assets. Second, and perhaps more importantly, it freed up a significant amount of capital that had previously been tied up in property the company was not actively using. The real question then becomes, what is First Majestic doing with all of this newly available capital? The answer points directly toward growth, not retreat. A large portion of these funds is being directed toward developing high-grade targets at some of the company's most promising active sites. These are areas where geological data suggests some strong potential for future silver production, but where significant investment is still required to fully develop and access that potential. At the same time, First Majestic has committed substantial funding toward restarting a major project in Nevada, with the company targeting production there by the year 2027. A mine restart of this scale does not happen with a small budget. It requires years of planning, permitting, engineering, and significant financial commitment long before a single ounce of silver is ever produced. This is the clearest evidence yet that First Majestic is not shrinking. A company that is genuinely struggling does not commit hundreds of millions of dollars toward future production projects that will not generate any income for several more years. That kind of long-term investment requires confidence. It requires a belief that the company will still be strong, still be profitable, and still be positioned to benefit when that future production finally comes online. In simple terms, First Majestic made a calculated trade. It gave up two dormant, non-productive properties in exchange for a steady stream of guaranteed income, and then redirected that income towards strengthening the parts of its business that matter most. This is not the behavior of a company retreating from the silver industry. It is the behavior of a company sharpening its focus, narrowing its efforts, and preparing carefully for a future it clearly believes will reward that preparation. But this decision, made by just one company, does not exist in isolation. It reflects something much larger happening across the entire silver mining industry, a pattern that becomes clearer the moment the focus widens beyond a single company and a single deal. Up to this point, the story has focused on one company, one mine, one carefully structured deal. But the true significance of this story only becomes clear when the lens is pulled back. Because what happened with First Majestic is not really an isolated event. It is a small visible example of something much larger happening across the entire silver mining industry. This larger trend has a name that some analysts use quietly, almost cautiously. They call it peak silver. The idea behind peak silver is simple to understand, even if its consequences are complex. It refers to a point in time where mining companies find it increasingly difficult and increasingly expensive to bring new silver supply out of the ground. Not because silver has disappeared, not because the earth has run dry, but because the easiest, most accessible, most affordable silver deposits have already been found and already been mined. What remains is often harder to reach, deeper underground, located in more remote regions, requiring more advanced equipment, more skilled labor, and far more capital investment just to bring a single new mine into production. This is the environment that companies like First Majestic now operate within, and it helps explain the decisions being made. Consider what has actually happened. First Majestic did not walk away from silver mining. Quite the opposite. The company sold off dormant, non-producing assets and immediately redirected that capital toward its strongest, most productive operations. It raised its own production guidance. It committed significant funding toward high-grade development projects. It began preparing for a major mine restart, aimed at future production still years away. This is not the behavior of a company retreating from the silver industry. This is the behavior of a company concentrating its resources, narrowing its focus, and preparing carefully for a future where bringing new silver supply online is harder than it has ever been. And this pattern is not limited to one company. Across the mining industry, similar decisions are being made. Companies are choosing to focus on fewer, higher quality projects, rather than spreading resources thin across many aging or marginal sites. Dormant mines are being sold, restructured, or quietly shelved. Capital is increasingly flowing toward a small number of high potential development projects, rather than being spread evenly across the industry. For someone simply watching the price of silver each day, none of this is visible. Price charts do not show boardroom decisions. They do not show which mines are being sold or why. They do not reveal the careful, long-term planning happening inside these companies. But for those willing to look beneath the surface, a clear and consistent pattern begins to emerge. Supply is tightening, not through any single dramatic event, but slowly, deliberately, through hundreds of decisions like the one First Majestic just made. This matters deeply for anyone who holds, or is considering holding, physical silver. Markets are ultimately shaped by supply and demand. When demand remains steady or grows, and supply becomes more difficult and more expensive to expand, the natural result is upward pressure on value over time. This is not speculation. It is basic economic reality, and it is playing out in real time within the mining industry today. The First Majestic deal, then, should not be viewed as a small, isolated business transaction. It should be viewed as a signal, a single visible data point within a much larger, quieter trend reshaping the entire silver supply chain. Major companies do not restructure their operations, streamline their assets, and commit hundreds of millions of dollars toward future production unless they believe strongly in the long-term direction of the market they operate in. Their actions speak with far more honesty than any headline or price chart ever could. And this raises the final, most important question of this entire story. If the companies that mine silver for a living are positioning themselves this carefully for the future, what does that mean for everyday people who are simply trying to protect and grow their wealth through physical silver today?